And now for a look at the Fed's rate path, the investing landscape, and more. Let's welcome David Rubenstein, Carlyle Group co-founder and co-chairman. Carlyle Group is one of the biggest private equity firms in the world, managing $382 billion globally. David, it's good to see you. He's like a media star. You do what we do in your spare time.
I'm trying to learn from you.
Yeah, exactly. Learn what not to do. We did have Jamie on and had we talked about a lot of things, obviously. But I think it really does matter what happens with rates this year,
right,
because built into the market, it's either 6 or 7, or when some people think there'll be 3, and we actually had the idea broached there could be still be a hike. So we don't know, but it matters because of what's in the market right now.
Nobody really knows, of course, and trying to predict what this Fed's going to do is difficult. But the Fed does generally telegraph what it's going to do pretty much in advance. They don't
know what the economy is going to do, and that's what we need to know.
Well, look, Jay Powell says, I'm very data-driven. The Fed is data-driven, so they'll look at what the data says. Right now, it's too early to say.
You need to tell me what the data is going to be.
Well, they're not going to make their next decision until March. So they'll have a meeting in January, but they'll just look at the data, and they'll wait until March before they do anything, almost certainly. The concern that I've had is that when you get into a presidential election year, it's very difficult to cut rates when you're right in the middle of a presidential election season, because the party that's out of power will say, well, you're trying to help the party in power.
Right.
Now, Jay Powell is a Republican. Presumably he's not trying to help Biden, but he's trying to do what's right for the country. So if he starts cutting rates significantly in September, October, November, or before the election November, people will say, well, you're helping the Democrats. And I don't think he wants that.
We have a whole Phillips curve. We don't even know whether we believe that anymore. And we just had a conversation. The Fed, maybe if it focused solely on inflation, that'd be one thing. But when it almost seems like they won't feel that they've accomplished their goals unless unemployment goes up, I'm just not sure that that has to be the case. Is it possible to have low inflation and leave unemployment where it is?
Well, the law was changed when I was in government so that the Fed has to worry about not only inflation but also by unemployment. However, Fed chairs are known in history for what they did on inflation, either getting it up or getting it down. And I think Paul Volcker's famous for not worrying about unemployment but worrying about inflation rate, and he got it down. I think Jay Powell will go down in history for having done a good job if he gets the inflation rate down to close to 2%.
David, I'm still kicking around in my head something that Jamie just laid out, the 3 case scenarios for the economy. And one of those scenarios he laid out is a hard landing and higher rates, because inflation is still out there and something the Fed says that they have to fight first. How likely of a scenario?
There's always possibilities, and predicting what the Fed's going to do or what the economy is going to do 10 months in advance is very difficult to do. Right now, I think most people would say the hard landing scenario is not really something they're worried about. Like most people would say that the Fed kind of dodged that reasonably well. Maybe the Fed doesn't deserve all the credit. Most people would say the question is whether it's going to be a soft landing, which is what we're looking like we're having, and whether we're going to have really good growth next year. In 2023, the growth rate is probably going to be about 2.5%. Mm-hmm. So we're pulling away from the rest of the world. And when COVID occurred, we were all in trouble. Now, China hasn't really pulled away, and Europe hasn't pulled away. But the United States is really growing quite nicely. I like to think it's because private equity people are given good techniques to business CEOs and so forth.
That's it.
But whatever the reason is, there's no doubt that the U.S. economy is in a league by itself. Now, it won't stay that way forever. And clearly, if inflation becomes much higher than we expect it will be, there will be a problem. But right now, it seems to be on a downward trajectory.
No, we don't want to go there. Do you think that private equity is so important to the health of the country that you guys should get special treatment? Still, we always get to that.
I didn't say that. I would say, obviously, I say some things that are tongue-in-cheek. But clearly, the revolution of private equity that really changed the U.S. economy beginning in the 1960s, 70s, and 80s, which is to pay much more attention to things that people weren't paying attention to in the 40s and 50s. In the 40s and 50s, the business community was much different. It was not as diverse as it is now. It wasn't paying attention to the kind of things that private equity do. And the techniques that private equity developed are used now by CEOs who are not in private equity firms. So I think we deserve some credit.
Oh, there's no doubt. And you'd rather have, if you have to lay off a quarter of employees to keep a company solvent and to be successful and to be here in 5 years, it's sad, but 25 got to go. I wonder about the combination of AI.
That's where I was going to go.
No one might be left.
Well, nobody really knows where AI is taking us. Nobody. And therefore, it's like at the beginning of the age of the Internet. We don't really know what the Internet was going to produce. And look, it produced some companies that are spectacular and some that didn't work as well as people thought. AI will change things dramatically, but we don't know really what it's going to do yet.
Has it changed your business, though, at all yet?
It has, because we're spending a lot of time on AI. We do a lot on AI with OpenAI, trying to figure out what deals are going to make sense, what things we should do with the companies we buy. For example, AI can really help you figure out whether a company is worth buying or not. Is it likely to fall into a certain trap or not? You know, you have to depend on human brains still, but the AI can be very helpful.
If that's the case, though, is everybody going to be competing? Is it going to make buying companies that much harder if everybody's using that large language model that basically does what your brain does right now?
Well, everybody's been using the same techniques for the last X number of years, so now we'll use a different technique that will be available to everybody. But you have to make your own judgment. In the end, AI can tell you something, but you have your own intuition, your own gut, and you're still going to rely on it. Warren Buffett, your friend, you think he's going to rely on AI to make decisions?
No.
Right. So a lot of the really great investors are not going to look on AI. They might be intrigued by it, but they'll make decisions on their gut, and that's what usually works out pretty well for people like Warren Buffett.
I have to ask. So you know the president, you know him well. Have you talked to him about carried interest? Would he like to get rid of that and raise some revenue? Do you know?
I have never talked to any president of the United States about carried interest.
You never have. Why?
Because I think
they have more, all the time.
I think they have more important things to worry about.
If you don't bring it up, you hope they won't think about it.
I think they have more important things to worry about. I know carried interest seems important to people on this show,
right?
But it's not that important.